repricing that jeopardizes financial stability?
Oh, I completely agree. This is a very sticky, tricky environment here because it's another version of like credibility, right? So you want to be able to steer the ship in the right direction, but to be able to do that, you need the whole team, the whole crew to push in the same direction. And here we have this disconnect. This disconnect is not new. It's been going on. We had a massive disconnect in January. It kind of waned a bit during February, but it's reopening now. As you say, we're clearly of the view that there's no cuts in the cards in 2023. The question is about when do they pause? It's about pausing, not cutting. And that, I think, will make them tricky, but this is what makes that situation very important for them. I think, this is where you get to an Arthur Burns moment. Are you going to be, clearly keeping your eye on inflation, or start to be swayed by other important consideration, but that might, start to blur the picture. So I agree with you, massive disconnect. It could be tricky. That's why we expect volatility. That's why we're pretty cautious, very cautious on the risk asset at this moment. But we think the Fed will very unlikely use the whole playbook and no cuts in the cards.
Given some of the repricing that we've seen over the past couple of weeks, which asset class in risk is more perhaps mispriced in your view, credit or equities?
Equities, I think, is where we have the most concern. I mean, credit, we've been overweight. We've scaled down the overweight. We're neutral now, and you could argue slightly underweight. So we've moved from positive towards aligning more with the equity view. But the equity is where we've seen more of the mispricing. We think there's significant damage to come. We've seen the cracks appearing. That is nowhere reflected in equities yet. And moreover, I think markets are still betting on some cuts, which will not materialize. So you put the two together, that makes equity. That's why we're on the way to equities for developed economies.
Jean, I once had a conversation, modestly off the record, but I think I can talk about it, with a guy named Ben Bernanke. And he brought up hockey stick charts. And they're not jump conditions, folks. They're just abrupt changes. Jean, we've had the mother of all hockey sticks with this rise in interest rates. What are the ramifications, the outcomes of a little Fed courage to go pause, pause, pause? If they take the slope out of the rate of change of the rise of interest rates and just go pause, pause, pause for 3 meetings, what happens?
Well, I think that the hockey stick story is more like we haven't seen yet the impact of the most rapid rate hike cycle since 1980. That was bound to create cracks. I think we're starting to see cracks. I think it has profound implications that we're just starting to see starting to be at play. The story of the last couple of weeks with the banking crisis is there was an idiosyncratic story with each of these institutions, but I think the broader story is, what we've been calling so far, for lack of a better name, the economics of deposits. We've been for the last few months seeing the rates that you can get on short-term instruments like money market mutual funds, ETFs, on short-term duration government bonds, and so on, diverge very significantly from deposit rates. So I think what we're saying is and we've seen deposit outflows from the banking sector on the back of this. This is something we haven't seen since you have to go back to the early 2000s to be in a situation like this. So there's profound adjustment that still haven't occurred. I think this is a big deal. And so while we might see pause, those effects are still in the system and haven't played out yet. So the hockey stick is more a rapid hiking cycle still playing out for me.
So if you were to speak to Kristalina Georgieva right now of the IMF, would you advise her that instability will be the norm into the summer?
I think this is the new regime. We've been always going back there. We've been saying that we are in a new regime. The great moderation is over because of the fundamental change in what is driving this macroeconomy, which is more about supply and production constraint, geopolitics, transition, climate. So that's going to be bound to be more volatile. I think that we cannot avoid this volatility. And it's not only for the summer. I think we're in this environment for some time. There's going to be opportunities, but these are relative value opportunities that we need to trace as investors.
Dr. Boivin, thank you so much. Jean Boivin with BlackRock Investment Institute. Lisa, you have been leading on this idea of, yes, fast, suddenly bank flows, and now clearly in the zeitgeist and into our weekend reading is the idea of, okay, it's not going to be the drama of February or March, but still those flows are going to be there. That disruption's going to be there, which I don't hear anybody talking about the easy road of pause, 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 just to give them time to observe what's going on. Those dates, Lisa, May 3, June 14, July 26. So maybe on July 26 they can reassess.
Pause, though, becomes more difficult when the market is pricing in cuts and when the market's pricing in pretty aggressive cuts. So if you don't deliver that and you don't guide to that, then you're actually going to surprise a market that has already moved way beyond what you said you're going to do.
Dr. Bovin says we're not going to see cuts. And
I think a lot of people
at Quinnipiac game yesterday were saying we're not gaping at Bank of America. Just forget about it.
Exactly. At the same time, and I was saying that profits have held in there to some extent with some companies, but they've been guiding lower, and you keep seeing that. So when does that hit some of the valuations?
Economic data here in 1 hour. Key economic data according to Jean Bovin. Futures up 7, the VIX 19.17. Stay with us. This is Bloomberg Surveillance.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Bloomberg Surveillance, and we say good morning to you 1 hour on from key economic data. Really through the entire week, there's been, I think, what John called tertiary data, and then you get to Friday where there's some real import to it. Michael McKee, after that data, in conversation with Susan Collins of the Fed, without question, our Fed conversation of the day. On the data, guess what? A lift to the market. Lisa's going to chime in here because she's got all the numbers on the NASDAQ. We have a bull market now on the NASDAQ, 20% off the bottom.
At one point, it was 20% off the bottom, and now people are saying, like Dan Ives, it has more to go because of the year of efficiency, and that people are still spending.
Even small caps up today. Russell 2000 up fractionally as well today. Two-year yield 4.14%, back a little bit in the last hour. We'll see what that does at 8:30. Some dollar strength, and I do want to note oil dashing to 75. Not there yet. 74.84 on American oil. We're going to get an 80 print on Brent crude, really over the last, I'm going to say 10 days, with a lift there as well. At quarter end, there can be movers, and then there can be the individual names of the moment. What do you start with today?
Well, I'm trying to stay as far away from the bank stocks as I possibly can because I'm trying to see whether we can shift on yet. We're still kind of keeping an eye on what's going on.
They really haven't. I mean, the market's come back, but Keefe Bruyette Index
has not. Correct. And that's been one of the questions. Is this just a sign of a change in profitability, given some of the flood of cash out of banks into money market funds, or is this something with people still concerned? I'm also watching, I have to go here, to Digital World Acquisition Corp. This is the blank check firm taking Trump Media public. And it's interesting to see that it's up more than 10% as everyone focuses on the former president once again.
Do you have a why on this? I mean,
probably it's...
I love this obscurity. This is like Bramo obscurity moment. Go.
Okay, just throwing this at the wall. Publicity is good. Publicity is good for people who want to get eyeballs. Well, and so if you think about the idea of a media company, well, what better advertising? Because evidently, as they say, no publicity is bad publicity. And look at what everybody's talking about this morning. I'm looking at Virgin Orbit Holdings. This is Richard Branson's outshoot that provides launch services for small satellites, saying that it was going to wind down its operations, ceasing operations indefinitely. It was cutting 85% of its workforce to reduce expenses. And this is because of a lack of meaningful funding. So perhaps one of the casualties of the funding squeeze, particularly in the tech sector, I don't want to make that leap too far, but those shares down more than 40%.
This has been challenged for a year.
Correct.
Or so.
So how many stories that have been challenged for a year that suddenly end up imploding do we start lumping in as something part of a larger story?
This is like the Bramo gloom stock check. You have the challenges of a former president's indictment. You've got Branson blowing up, to use an apt phrase. And then what's the next one you've got from my childhood?
BlackBerry. Okay, let's be very clear. BlackBerry used to be that little device where you could have, like, used your thumbnails.
You're too young to remember this.
No, I had a BlackBerry, but those shares are down almost 4% because it's actually now a cybersecurity company.
Yeah,
and that's what it focuses on. Yeah, it's something odd because it's not what it was. But basically, fourth quarter estimates fourth quarter revenue, I should say, missed estimates. And there are some concerns about government deals slipping at a time when there is going to be a lot of competition for these kinds of services.
I think that's the worst market movers you've ever done. That was totally gloomy, story stock or that. Where's the
Happy
blue chips
Friday
today?
Happy Friday.
Can't you do Apple in there or something?
Well, look, I look for the stocks that are moving the most, not necessarily the same 5 stocks that we look at every single morning.
Yeah,
if you take a look at Apple, it's down a tenth of a percent.
It's down a tenth of a percent.
Oh my God. Oh my word. Thank you, Tom. Thank you for that insight. Meanwhile, we're waiting for Michael McKee's interview with Boston Fed President Susan Collins. That will be insightful, unlike what evidently the most terrible market movers that I've ever done was. It's going to be following that core PCE data. Richmond Fed President Thomas Barkin seeing, quote, pretty wide range of outcomes for the next Fed meeting, saying, quote, I could imagine many different outcomes based on whether you can convince yourself that inflation is starting to settle, or you convince yourself it's not, and you convince yourself that this was a blip that is sort of largely behind us, or you're convinced that this is a continuing situation. Talk about soup. Talk about a muddle and a lack of certainty, even from the top officials.
Soup is something I use, folks, in technical analysis. It's when you can't really read what's going on. And you're absolutely correct, Lisa, that this is a soup we've never been in. I mean, never.
I mean,
ever.
We're looking for guidance from Fed officials. We're looking for guidance from Fed officials, and the guidance is we can convince ourselves of anything that we want. We're not sure yet.
That's where we are. We've had a good guest to talk about this uncertainty that's out there. RJ Gallo, with decades of experience, Federated Hermes. RJ, Lisa's got a lot of really good questions for you about the linkage here of our economics into investment. I want to pause and talk about your true expertise in municipal finance Is municipal finance harmed by this banking crisis?
Well, good morning, Tom, Lisa. Thanks for having me. So far, the muni market has sort of waded through this rather well. In fact, muni yields have held pretty stable while treasury yields have been whipping all over the place, up and down with the latest news about a next second-tier bank that's been struggling. The muni market still has pretty strong demand. We've seen a lot of retail investors coming in through SMAs, also direct bonds. The mutual funds, it's been a little more quiet, a little money in one week, a little money out the next week. I think the key thing to watch on the muni side, banks hold about 15% of the outstanding supply of municipal bonds. And most of those munis are actually held away from the GSIBs. Thus far, they really haven't been too active on the sell side. But remember, this whole banking question has to do with assets, decline in assets as rates rose, and deposit flight and deposit confidence. So far, munis have done very well, but that's a risk factor to watch. We're reasonably optimistic that's not going to become a big problem, but you have to see how it unfolds.
How is Federated going to be opportunistic? And folks, Federated has an immense heritage here in the invention of money market funds. How will Federated be opportunistic given the massive flow to money market funds?
Well, these days, cash is very much a valid asset class. People who want stability, but want some nominal income, albeit still below the rate of inflation, but we think inflation will come down. I'm sure we'll get to that. If you look at government money market funds, you have yields around, give or take, 4.5%. That's an eye-popping high number compared to the last decade plus of experience for investors who wanted relative safety and stability, but had to only got a little over zero interest rates for so long in that asset class. We're in a good position as a firm to provide these kinds of solutions for investors who are looking for some safety and security in an uncertain time, and able to give them some yield as a result, because the interest rate environment has massively transformed, really, compared to where it was for much of the last decade plus.
I love that you have a view into the nitty-gritty of municipalities that are struggling with some pretty significant issues right now. I think in particular of commercial real estate, we keep talking to people about how that's the next shoe to drop. Are you seeing it starting to affect valuations of any specific municipalities that you invest in?
We've been talking about this now for well over a year. The work from home dynamic fundamentally transforms the risk profile of office properties, and from a municipal standpoint, a lot has to do, of course, with the value of those properties on the tax rolls. Of course, there's a variety of daisy chain effects. Office properties declining in value, which is clearly going to happen, is going to have an impact on the value of the mortgages that finance those properties, which are going to affect the investors who hold those mortgages, sometimes in CMBS trusts, but oftentimes in second and third tier banks in terms of asset size. A lot of regional and local banks finance plenty of commercial property, and some of those office properties are going to end up becoming struggling assets on their balance sheets. On the muni side, there's such a long lag between the decline in property valuation and when it actually shows up as declines in tax assessments. So far, you're not seeing it in the financial results at all. In fact, municipalities are coming into this period of slower growth and uncertainty from a period of strength of their balance sheets and their recent performance on tax flows. But it's a key risk to watch. We as investors are focusing on those communities that have high concentration in office property without the diversification of other sorts of commercial property as well as residential. And so it's a little bit more than just focusing on the big cities. There are oftentimes smaller communities that might have a narrower tax base where offices are disproportionately large. That's the challenge as we go into the next couple of years, because it will take a couple of years for this to unfold, I think.
Just to sort of build on this, we've seen a number of sea changes post-pandemic, including a lot of people migrating to the Sun Belt. Do you see a commensurate increase in the financial portfolio of some of those Sun Belt states as a result of some of the in-migration?
Well, there has been a shift in sort of issuance volume across the muni market. If you look at how the muni market is comprised, the largest states have the most infrastructure. Munis are the primary means through which we finance infrastructure in this country. Toll roads, water and sewer, buildings, you name it. And we are seeing some shift in the composition of the market in relation to the growth patterns as people are migrating, say, out of the Northeast or the upper Midwest and heading into the Southeast. That is absolutely true. The credit quality of the states, I should note, is quite strong right now. One of the states that's actually been losing people, the state of Illinois, has just experienced in the last 8 weeks upgrades from 2 ratings agencies back into the single A territory after years in the triple B space. And a few years back, people were debating whether or not that was a junk loan. States are strong issuers, strong credit quality issuers in the marketplace. This migration issue is something to watch, but we still think even some of the states that are losing people are doing pretty well.
Too much optimism. R.J. Gallo, thank you so much as Federated Hermes there. That's something we don't do enough. And Lisa, I'm wicked guilty of this. We don't do enough on the simple concept of taking advantage of tax-free bonds. That's a huge psychology for a large part of our audience.
Especially right now, and suddenly they're yielding something. And that's the reason why you've had so many people say, this is the year of the bond, this is a year to go into it. And we're starting to see it at a time when also these states still have pretty strong credit profiles.
And of course, Federated there, as I mentioned, with their heritage and the money market fund as well. This just in at Bloomberg surveillance as we go to economic data here in less than 1 hour. Apple Computer in pre-market still down 0.1%.
Thanks, you're killing it.
Had to get that in there.
I'm glad.
As well.
Tom wanted to give the competing market check to the competing market movers.
To BlackBerry and Virgin or whatever it is. What's interesting here about this polarity in the market, somebody said the lift in the SPX is 8 stocks. I mean, I don't know how to process that.
What you do is you take a look under the hood and you see some really interesting shifts and you don't even get a narrative from that. It's just as confusing. So don't worry, you don't get any clarity there either.
Yeah, we're gonna dive into, probably we'll do an entire segment next week on the triple leveraged all cash fund and its view for second quarter. 8:45 this morning, Susan Collins with Michael McKee. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. History has been made as Donald Trump becomes the first former U.S. president to face criminal charges. A Manhattan grand jury has decided there was enough evidence to move ahead with a case against him for his role in paying hush money to a porn star during the 2016 election. Trump's lawyer said he could be arraigned as early as Tuesday. Trump described the case as the latest effort by Democrats to destroy the Make America Great Again movement. The Biden administration is going to unprecedented lengths to play down the importance of Taiwan President Tsai Ing-wen's visit to the U.S. It's an attempt to keep the relationship with China from getting worse. People familiar with the matter say Beijing's unhappiness may be more muted than expected. Tsai scrapped some events in the U.S. and limited her press engagements. In the euro area, inflation fell by the most on record, but core inflation set a new high. That highlights the tricky task facing the European Central Bank as it decides how far to lift interest rates. Consumer prices were up 6.9% in March from a year ago, down from 8.5% in February. Core inflation, which excludes volatile items such as energy, rose 5.7%. The UK is joining an Indo-Pacific trade bloc in a major post-Brexit deal. The 11-nation comprehensive and progressive agreement for Trans-Pacific Partnership includes Australia, Japan, and Canada. Prime Minister Rishi Sunak's government sees growth of $2.2 billion each year over the long term. That could grow if others join the bloc. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
Studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
To me would be Trump has better chance of winning nomination, worse chance of winning the general election, which is the name of the game, in my opinion.
Gregory Vallier of AGF Investments, with his decades of experience, one common ground John Farrow, Lisa Bramos, and I have is given this historic moment for the nation and the news flow that we'll see to a presumed Tuesday arraignment of the former president of the United States. We're going to talk to people with decades of experience. We're thrilled to have Timothy O'Brien running Bloomberg Opinion on all the financial matters of Mr. Trump. We're trying to get him on here as we can, the legal experts of Bloomberg Opinion as well. And one of those is to get former federal prosecutors with esteemed history. Michael Zeldin is described by that, adjunct professor at American University, Washington College of Law. Michael, thank you so much for joining us. What was your first day at Justice like ages ago? Is the Justice Department now the same Justice Department where you walked in out of Binghamton in your legal practice years ago?
I believe it is. I believe that under Merrick Garland, they are committed to the rule of law and to following the facts and the law and to dispense justice even handedly. So yes, I think they are.
What will we see Tuesday if we have a presumed arraignment of X number of items? Can you prejudge that or pre-analyze that?
Well, we can guess that Trump is going to be charged with a campaign law violation, and a business records violation. The business records will probably be 10 or 12 different business entries that reflect payment to Michael Cohen as legal fees, which were in fact repayment of the Stormy Daniels $130,000 hush money payment. So we might see a 10 or 12 count indictment, but really it boils down to one hush money payment by Cohen to Stormy Daniels, and then a 10-part or 12-part reimbursement of Cohen for that. That is a business crimes offense in New York, and it is a misdemeanor. They can make it a felony if they say that those payments were made as part of a other crime, and that other crime is a federal campaign elections crime, a theory not previously tested in New York. So it's not a simple case, but that I think will be the outline of what we'll see on Tuesday.
Michael, there are people who are watching this who are frustrated to be dragged back into wall-to-wall circus coverage of this question of, hush money paid to people who may or may not have had affairs. This is really one consequence of an era that a lot of people want to perhaps move on from, move forward, and yet the erosion of the trust in the judicial system continues. How much do prosecutors weigh this type of social response when deciding whether to go forward?
It's part of the calculus, but it shouldn't be the primary calculus. The primary calculus has to be, were laws violated, and is accountability required for that law violation? And I think that in this case, though it's an old case by current standards. It is a case that I think the Manhattan District Attorney's Office felt accountability was required, and therefore they brought it. Now, yes, it's true that people would like to move on from this, but people would like to move on from January 6th, and there needs to be accountability there. And people want to be moving on from all sorts of things in the Trump era. But we still need a reconciliation with what occurred so that we can learn from it and move forward as a country away from it.
Given the fact that you just talked about the nature of this particular crime, do you think that there will be blowback to the New York prosecutors going forward with this?
There already is. I mean, he's already been labeled as a Soros-funded liberal and a racist by the former president. So yes, I think that part of the strategy in the court of public opinion is going to be to demonize Bragg and try to delegitimize the prosecution.
Michael, it's the honest thing, folks. I remember exactly where I was standing on the OJ decision years ago, and you provided the nation with legal coverage at that time. Michael Zeldin, Donald Trump was 27, 28 years old in 1974, where Wilbur Mills and, it was in the Jefferson tidal basin and the scandal and uproar then, and the 14 other scandals you followed. Is the job change for federal prosecutors because of the cultural acceptance of this or that vice along the way? Is the job now of your world totally different than it was in 1974?
Well, yes and no. So when Wilbur Mills and Fannie Fox fall into the tidal basin, I don't think people were talking then in Me Too terms. I think that was thought of as, well, that's just the way the system works. Now, in the aftermath of the Me Too movement, I think that sort of behavior is intolerable, and that's good. And so I think, for example, had Bill Clinton done what he did with Monica Lewinsky, now he would have been removed from the office of president. I think that we're at a better time now than we were then with respect to this misogynistic behavior.
Michael Zeldin, for our audience international, what should they look for on Tuesday when we get this arraignment? How should we approach the news frenzy that we're going to see?
I really think that a lot of that depends on how Donald Trump wants to play this. That is to say, if he wants to do what the Justice Department would like to do, or the Manhattan District Attorney's Office would like to do, he'll come in through a private entrance in a car, he'll go up in the judge's elevator, he'll go into the courtroom, he'll make his not guilty plea, he'll be fingerprinted and mugshot, he'll go back down that elevator and leave. And that will be the end of the day, a 1 hour process. If he elects to make a spectacle of it, wanting to be handcuffed or go out in front of the court and talk about how he's the most persecuted person in the history of America, then you'll have a street scene that really won't be controllable as easily. So hopefully he'll do the right thing and just try this case in the court of law. But, Donald Trump is Donald Trump, and he'll do what he thinks is in his best interest, irrespective of whether it's in the national or the city's best interest.
Michael Zeldin, thank you for joining Bloomberg Surveillance this morning. He is a former federal prosecutor, years of public service in our Department of Justice is Thel. I learned a lot there. I mean, I am the amateur on this, and, it's away from what we do, economics, finance, investment, but I was taking notes. I mean, that was very interesting with a former prosecutor.
Considering that the election cycle lasts about 2 years, we will be hearing lots about this, as well as what this means as far as the implication for the race for the next president, how much oxygen this takes out of the room, and a lot of people would like to move on. We're looking right now also to try to move on from the maelstrom of uncertainty that we've had over the past 3 months. I mean, John was talking about how he'd like to see the year-ahead outlooks on March 31st. Do we have more clarity on March 31st than we did on January 1st?
You let the cat out of the bag. This is why John is off today. He's rewritten it like 3 times this week, and he called me last night. I was having a beverage of my choice, and he said, Tom, I got a problem. Can you handle the show tomorrow with Lisa? Because I just got to do a read. It's 72 pages, and he says the first 15 pages are pretty much locked in because they're a look back. And then John's struggling with his year-ahead outlook to get it published April 1.
Yeah, but you could do a look back like for a week ago, or you could do a look back for 2 weeks ago, and it's a completely different narrative. So, this has been the sort of issue of this year. Blink and you'll get to the same place, but just with a lot of turmoil under the hood.
I go back to the great charts, and we're going to see this with Jim Bianco joining us here as well. We're going to see Jim Bianco, I believe, in the 8 o'clock hour. Susan Collins with Michael McKee in the 8 o'clock hour. It's going to be a spectacular effort as well. I want to draw your attention, a special announcement with Amory Horton and Joe Matthew tonight. Balance of Power with an important guest, Mick Mulvaney, the former acting chief of staff for the former president, will join. Look for that in the 5 p.m. hour. That will be certainly of Washington and national interest. Balance of Power, the 5 p.m. hour tonight. Futures up 7, Dow Futures up 68. We are 30 minutes away from key economic data. Please stay with us from New York. Lisa Abramowitz and Tom Keene. John Farrell writing an outlook. This is Bloomberg. Good morning.
Welcome back to another Miami Open update for Bloomberg TV and radio from Tennis Channel. I'm Johnny Ray Diaz. Former U.S. Open champion Daniil Medvedev ended American Chris Eubank's Cinderella run in the Sunshine State to punch his ticket into the Final Four. Despite the defeat, it's been the biggest week of Eubank's career, reaching his first ATP 1000 quarterfinal and cracking the world's top 100. And don't forget, you can watch all the action exclusively live on Tennis Channel. I'm Johnny Ray Diaz.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
Access the financial world on demand. Hear from leading economists, policymakers, and industry industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I've been in the camp that we are generally headed towards deflation, especially in the goods camp.
The Fed said, hey, look, we told you that inflationary pressures were going to be high, and they were.
The Fed didn't think they were going to be raising rates at this pace, and that we'd see other central banks do the same.
One of the key things you want to do as a central bank is to provide that confidence that you have resolve to fight against higher inflation.
The question, can central banks have a foot on the gas and a foot on the brake at the same time?
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
And now we get the data that matters. Good morning. This is Bloomberg Surveillance worldwide for our audience from New York. Bloomberg Surveillance live on Bloomberg Television and on Bloomberg Radio. Tom Keene, Jonathan Farrow, I'm Lisa Abramowitz. Jonathan Farrow is off today. We are looking for some clarity amid all of the uncertainty, and we get some, Tom, today in about a half an hour.
So Michael McKee, we're trying to get to join us here later in the block. Amory Horton with us in a moment. And you know, I forget how much we're hinged on this Friday. Personal income, PCE deflator, 8 flavors of that. And to your point on the confidence of the nation off the political maelstrom in Washington, we get the economic conference of the nation, and we forget amid high inflation.
And this really is the key point. We've been talking all about potential disinflationary credit tightening from bigger and smaller banks alike. We've seen it already in the data. A lot of Fed officials have come out and talked about the acceleration of that credit tightening, and yet it isn't crimping inflation yet. So how is the market going to respond if this day that we get the core PCE, that key indicator that the Fed looks at, comes in hotter than expected?
Let's go through those numbers right now. Headline PCE deflator 5.1%, down from 5.4%. In the core, Lisa, 4.7%, sort of unch, but we've seen surprises out of Europe as well. So I think there's a mystery to what we're going to see here in 27 minutes.
When you talk about Europe, we did get weaker than expected headline numbers because of energy disinflation, but ongoing strength in core, reaching new record highs. Let's just take a moment for a second. We're closing out. This is the last trading day of this quarter, and it has been an absolute roller coaster of data, of narratives, of Fed speak, of policy prognostications, and we are not ending it with any more clarity than we began.
Oh, I think less. Oh, no, I think less. I think the flows in the banks and the money market funds, that wasn't there January 1st. And to me, if anything, there's greater uncertainty here. To work backwards in the hour, Mr. McKee with Susan Collins of the Boston Fed. She is absolutely exquisite, front-rate academics there. Luzetti of Deutsche Bank darkens the door after the economic data, so this is very strong. A guy named Bianco shows up in the B block, you know. Cubs, White Sox, you know.
Well, if you think about the Tom Barkin comments that we heard, right? You can convince yourself of anything you want. To your point, Tom, you are correct. It's a really good statement. Potentially, there's even less certainty right now, as people basically are looking for confirmation bias in the data that supports what they're trying to say.
6 seconds. I know we got to get to Amory Horton, but I mentioned this yesterday with the great people, Quinnipiac, 1,200 college kids in their game forum. My Bible that I give to young kids is Against the Gods, Peter Bernstein on risk, uncertainty, and Douglas North's ambiguity. And the answer is all the risk measurement has just shifted over to unmeasurable uncertainty. It's just as simple as that.
And there's one answer when there's unmeasurable uncertainty, and that means buy stocks, essentially, because that's what we've seen so far in the past 3 months. Just giving you a sense of where we are. The S&P up about 6% so far year to date, and just the shocking outperformance has come from the big tech complex, with the NASDAQ up more than 15% so far in the first 3 months of 2023.
I think when there's shocking uncertainty, what you do is you bring in Amory Horton. I mean, when the uncertainty is that large.
Well,
you know,
okay, so then you throw all right, you keep mentioning the political maelstrom. We know that the former President Trump was indicted by New York authorities. He's going to be arraigned on Tuesday. He hasn't yet had the actual complaint revealed, so we don't know the details, but we are getting reaction from a lot of different political operatives. We're also getting a sense of what this might mean for policy for the presidential election upcoming. Anne-Marie Hordern, our Bloomberg Washington correspondent, joining us now. We've had this news. We've digested it less than 24 hours, maybe 12 hours. What's been your biggest takeaway from this whole affair?
Well, there's too many questions, right? That's my takeaway. I think everyone's coming out and making a lot of statements, but we just don't know yet. As you mentioned, this indictment is under seal. We probably will not know what these charges are until the former president shows up for his arraignment, which is going to be Tuesday. What we do see is already a polarized America, and this is just going to harden that polarization. And it is a historic moment, of course, in American history and American law. But there's still so many questions.
Right. And Lisa, jump in here as well, because you've got some real knowledge here. I was dazzled by Michael Zeldin. Here's a former Fed prosecutor talking to us, and it wasn't the hysteria of the modern American political cable TV thing. It was just these guys. They're just doing their job. Whatever Republican, Democrat, they're apolitical. Do you go with that?
Well, that is not what Republicans say.
President Trump did not suggest that, did he?
The Republicans are saying that this is politically motivated. And they think that what they would call this is a, quote, witch hunt. And what you see in Congress is people like Jim Jordan, James Comer. They actually, there is talk of having a subpoena to Alvin Bragg to bring him into Congress and for them to show their documents in terms of how they came about this indictment.
And what's important here, folks, is not only am I surrounded by Mets fans, I mean, that's a problem in itself, but I'm actually surrounded by people who actually know what they're talking about. Is a federal prosecutor, Lisa Abramowitz, in Dallas, Texas, the same as a federal prosecutor in New York City?
I will just say that the prosecutor offices are all slightly different, whether it's federal, whether it's state. We're dealing with the state here, not federal, which is interesting in and of itself and raises some issues. So we are going to parse through all of the details. What I've been looking at is the overall implications, and I go to polling because I want to understand what the larger social implications are for the United States, both nationally and internationally, for policy perspective. Last year, a Gallup poll, I thought this was fascinating, found that only 14% of respondents had, quote, a great deal of faith in the criminal justice system. That's down 20% from 2 years earlier. Most Americans are already convinced that the prosecution of Trump is politically tinged. March 21st, Reuters Ipsos poll found that 54 respondents, including 80% of Republicans, thought that this was politically motivated. So this is how people are reading it in the public. And a March 29th Fox News poll found that Trump was expanding his lead over the Republican presidential candidate to 54%, followed by DeSantis at 24%. So President Trump, former President Trump, has a greater chance of being the Republican candidate as a result of this.
100%.
And that is basically the big takeaway.
He will run on grievances. I am a martyr. And he's campaigning on it. What did they do last night? Immediately, within minutes, they sent out campaign emails. Remember, when the FBI was about to go into Mar-a-Lago, he was bringing in $180,000 about a day in campaign funds. This is how he makes money. The issue he has in the latest polling is, yes, maybe he'll be the candidate, but Biden still beats him in the polling.
Less than 30 seconds here is what I've got. The Sunday talk shows, they'll be on Bloomberg Radio in the afternoon as well. What are we going to hear? What's going to be the play on the Sunday talk shows?
It is going to be polarized. It is
completely polarized.
Completely polarized.
Politics.
Yes. The people you will not hear from, though, the officials you will not hear from is the White House. They are going to be silent on this. They're going. The former president, the president today, while the former president is in Mar-a-Lago, potentially concerned about what his political future looks like, what his legal future looks like, the current president will be in Mississippi touring these devastating tornado ruins.
We're going to run to what we really do on Bloomberg Surveillance. Balance of Power tonight. Anne-Marie Hordern, Joe Matthew, Kaylee Lyons has the Friday off. Look for that at 5 p.m. Michael McKee now with us, 20 minutes away from key economic data. Michael McKee, I see in Europe the vectors of inflation are confused, top line and core. Are we as confused in America with a trend of top line inflation and core inflation?
I don't think so, Tom. We're pretty much happy with the way things are going with top line, because essentially you're seeing the same thing as in Europe. Energy prices falling and that bringing down the overall index. We're making progress there, but it's the core that the Fed is worried about, and we'll get the PCE version of those numbers today. And they're watching, as they have said, core services, and the fact that services industries have to, their biggest cost is labor, and labor prices have still been going up. So we'll see what those indexes indicate about progress that they're making against inflation. And it's sort of a race between the other two numbers, income and spending, because is the economy slowing faster than inflation? That's going to be the question for the Fed.
Mike, you asked one of the best questions of all on the last Fed meeting when you talked about what do you think of the fact that a market is pricing in rate cuts at a time when you keep saying that is not on the table. How much have you gleaned from Fed officials about how much they're willing to push back on a market that has gotten way ahead of them?
They're willing to push back, but I think they're more or less waiting for the data to push back at the markets. And if inflation still comes in at strong levels and the economy hangs in there, that makes the case that the markets are wrong, that they're not going to have to cut rates because we're not falling into recession. So they're going to wait and maybe let the data do their work for them.
Michael McKee, thank you so much. We'll see you again here in 19 minutes. Mr. McKee, at the meetings of the National Association for Business Economics, his key interview with Susan Collins coming up as well. 5%, that's the emotion. 4.9% is not 5%, is it?
Well,
5% is a round number.
Well, and we've come down from that a bit, and yet money keeps going into those money market accounts. The tension to me is, what does it take for people to want to put their money in cash? It means a lack of optimism for the rest of the economy, that you're going to get outsized results from corporations, from riskier assets that normally deliver the bigger gains. And to me, that is the question, the sort of tension underpinning why some of the recent moves don't really add up to a lot of people.
Maybe it's price up, yield down, because you're 100% right. We're not at 5% now on the various short-term paper, but 3-month LIBOR, and being a fossil, that's what I quote, 5.19% on 3-month LIBOR. And I'm in the camp with the zeitgeist of the last 48 hours that, okay, the drama's over. Silicon Valley Bank and the rest of it. But now the emotion starts of what people do with their money.
And now the emotion starts of banks saying, oh yeah, I'm not going to give you that extra
5%
credit line. And we're hearing about that anecdotally.
His office in Chicago is lined up with toasters from banks. He's the ultimate collector of deposit flows. Jim Bianco leading the zeitgeist right now. He'll be with us soon. Stay with us.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. As you've been hearing right here on Surveillance, for the first time ever, a former U.S. president has been indicted. His lawyer says Donald Trump is expected to be arraigned on charges as early as Tuesday. A grand jury in Manhattan decided there was enough evidence to proceed with the case against him for directing hush money payments to a porn star during his 2016 campaign. The exact charges haven't been made public. The former president calls it political persecution and election interference. A bipartisan Senate effort to shore up Social Security is hitting a political roadblock. Some members of a group trying to come up with a deal say there are two problems: President Biden's accusations that Republicans want to cut benefits, and Donald Trump's promise to leave entitlement programs alone. Now, it's estimated Social Security trust funds will exhaust their reserves by 2035. Finland has cleared the final obstacle to joining NATO. Lawmakers in Turkey unanimously voted Thursday to ratify Finland's entry into the military alliance. The vote seals a major change in the European security architecture. Finland and Sweden sought NATO membership following Russia's invasion of Ukraine. Turkey and Hungary still oppose Sweden's entry. And Bitcoin has made a surprisingly fast exit from its crypto winter. With a roughly 70% gain, the notoriously volatile digital currency is closing out its best quarter in 2 years. And it's the best performing asset class by a wide margin. Market watchers are at odds for the reasons behind that big rally. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Bloomberg has the Fed coverage you're looking for. Today, an exclusive interview with Boston Fed President Susan Collins.
Restoring price stability does remain our imperative.
For all your Fed coverage, keep it tuned to Bloomberg, your global business authority.
These events remind us of the urgent need to complete unfinished business, to finalize post-crisis reforms, consider whether deregulation may have gone too far, and repair the cracks in the regulatory perimeter that the recent shocks have revealed.
The best National Association for Business Economics meetings in years. Just a terrific lineup down there. Someone like Diane Swank, hugely involved with NABE, and of course Michael McKee in attendance with his important interview with Susan Collins there, the Treasury Secretary, amid this bank crisis. One of the great joys here is I really don't know who's coming on the show. There's this immense faith that our bookers always get the best people, and there's sort of like a back and forth. But, you know, the surprise, Lisa, of Jim Bianco walking in the room was pretty cool. I mean, I did not expect this.
We got it on a rundown before.
I never look at
I was very excited that he was going to come.
I never look at the rundown as well. This is what's going on in New York, and this is why Bianco of Chicago is in New York in an hour with Yuri and Timmer of Fidelity, who's outstanding on charts. He will be ensconced in front of 1,200 college kids. For those of you, it's a closed entry. You can't just show up. But it is spectacular. Here I was yesterday with 4 esteemed economists in front of 1,200 smart college kids asking Quinnipiac College, this is their baby up in Connecticut, and a major shout out to all at Quinnipiac College, is Jim Bianco will be in a room full of silence. Why is that? Well, guess what? Elon Musk, meet Jim Bianco. Jim Bianco is what Twitter is all about, and he is definitively led on Twitter in this banking crisis with intelligent threads. He joins us right now. Have the flows stopped? The deposit flows, the money market flows, where are we right now?
It hasn't stopped, but it has slowed down a little bit. But it is still, if you go back to prior to March 8th, a huge number of money is moving from the banks to higher yielding alternatives, whether it's money market funds or it's treasury bills or ETFs that are very short term. The public has woken up. They've found out that I'm getting 0 at the bank. I can get 4.5 in something else. If you have $250,000, that's in the bank. That's like 15 grand a year, 14 grand a year, and they're making that move. They have been, and they're not stopping.
Is it still destabilizing? There seems to be a zeitgeist out there that, well, that was harsh, Silicon Valley and all that, but we're through that, and now there'll be a lesser instability. Do you buy it?
Yes and no. Yes, the initial response that is another bank going to fail? Probably not at this point. Is there going to be another hemorrhage? Hopefully not. But is the public going to slow down? Are they going to say, I'm fine with 2 basis points, literally, at my Chase account, and I'll just leave my money there? No, they're not going to do that either. So the flow, I think, away from the low-yielding bank deposits to high-yielding alternatives will continue, and that will continue to pressure banks. as they struggle to understand their deposit base.
So let's talk about those money market funds, which reached $5.2 trillion is the latest data from ICI that came out on Wednesday. We have seen it increase at an astronomical pace over the past 2 weeks, with $100 billion alone. Over the past 4 weeks, more than $300 billion of inflows, which is taking us back to the pandemic era. Where do you expect this to go? What are you looking for when this hits the breaking point at a time when you're also starting potentially to see the ramifications of the rate hikes in other capacities?
I think once you see the spread between deposit rates and market rates collapse and basically offer the same deal, as long as, like I said, as long as you get 1% or less in the bank and you can get more than 4 in a money market fund, that is going to continue. Also keep in mind, in the post-financial crisis era, 75% of the money that is invested by a money market fund is either in a T-bill or a Fed reverse repo. So in the old days, pre-2009, you'd say, well, the money's going to money market funds. They buy commercial paper, and they still fund corporate America. Well, they still do that, but not nearly to the degree that they used to. They're funding the government, and they're funding the Fed now.
So translate this into 6 months from now, and what this means in terms of access to credit, either defaults or simply firings and sort of a restraint with respect to business plans. How much more do you see that than perhaps is getting priced in?
Well, I do worry about that. Collectively, the regional banks are $6.8 trillion in assets. Collectively, they're larger than J.P. Morgan and Bank of America combined. So collectively, they matter. They fund 80% of commercial real estate, 50% of personal loans, 40% of commercial and industrial loans. If they've lost visibility on their deposit base and they don't know what's driving their depositors, and their depositors are leaving and going somewhere else, they're going to pull back on their lending. A quick point. When we talk about banks, I always like to ask people, what do you think a bank is? And most people would say it's a warehouse where I keep my money and I get an interest rate. Okay, that is the definition of a bank. But for regulators and bankers and everybody else, it's a credit intermediation. It's a way to get a loan. It's a way to expand a business. And if the warehouse of money is going somewhere else, that lending action is going to really change.
We're seeing that in the price of bank stocks. Where are we not seeing this priced in?
Well, the thing about bank stocks is there's two things about them. Are they pricing in potential more defaults or failure? Or what I think they're pricing in is a squeeze of their margins because they're going to have to raise deposit rates and their profitability is going to be under pressure. That's why the bank stocks have not really recovered, because there's a worry that in order to get past this problem, they have to start making less money.
Let's bring it back to the Fed. Economic data here in 7 minutes. Michael McKee will join us with that. Jim Bianco, the Fed here, and we had no landing, this landing, O'Hare landing, whatever the landing is. What's the efficacy of a pause right now? Or as I mentioned earlier in the show, how about 3 pauses? Pause, 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 just to wait to see, to get to July to see where we are. Is a pause a good thing?
If we continue to have a credit crisis or credit problem, yes. But the Fed is not thinking pause right now. They're thinking about inflation. They're thinking about a pre-March 8th world and whether or not we are going to continue to see, high inflation, persistent inflation, a no landing, a strong economy. If that's what they believe, they're going to continue to move forward with their rate hikes. But if we start to see a slowdown in credit, that should lead them to a pause.
Cubs, White Sox, what do you think? What's the story in Chicago this year?
Yeah, they're both 100% right now, 1-0, and we're at the Cody Bellinger era in the north side of town, and we're still in the Tim Anderson era in the south side of town.
Which way are you tilting? I mean, who are you going to see? This is a hugely important Midwest thing.
It really is. At this point, I hate to say it, but I'm kind of leaning towards the Cubs. I've always kind of had a bias for the White Sox, but the Cubs are the more interesting team right now.
So we got news we can use there. You see that?
South side, let's go.
Jim Bianco, thank you. And Jim, congratulations on being definitive on Twitter. I mean, if Elon Musk needs to know anything about the communicative thrust in the crisis of Twitter, there's other people out there as well, but Bianco's doing these threads. You can just feel all of Twitter just stops and goes, oh God, another Bianco thread. I got to read it.
It's a continuation of the amazing notes and the amazing reports that he's put out for decades. And I will say, and I've always enjoyed reading them, but what he was talking about there, parsing both the credit impulse of some of these smaller banks with how the Fed responds, it is an incredibly difficult moment, especially because what you see is market pricing in one response and then potentially having to come out, jar them at a time when we're seeing unprecedented volatility in some of the short end rates.
The mathematician Clifford Asness sends his greetings. He's out here on Twitter going back and forth with what Bianco's saying. I mean, it's when you get Jim Bianco and Cliff Asness talking about what we're doing. That's pretty cool.
30 seconds,
We're up
Jim.
to 42 viewers.
30 seconds, Jim. Do you think that the Fed can avoid cutting rates by the end of this year based on the market kind of pushing them that direction?
No, if the economy does take a dive, they'll have to respond to it. So they don't want to do it, but they'll be forced into doing it if we have that kind of credit problem that I fear.
PC deflator here in 6 minutes. You got a view?
Watch the core. The core has been surprising to the upside, and I think that that's going to give the Fed more impetus to raise rates if we see
As in Spain, you know, there's some other nations having the same trend.
Right. You've seen that all throughout. A lot of countries have been reporting that the core numbers have not been coming down as fast as they hoped.
Very good. Jim Bianco with us here. Very importantly, congratulations on the 5%, I should say, dialogue as well. We dive into 35 minutes here of important economics. Of course, the data coming out, Matthew Lazzetti, I believe, of Deutsche Bank, scheduled to be with us. And then the gentle lady from Ann Arbor, Susan Collins, the Boston Fed president, with our Michael McKee at 8:45. Stay with us on radio, on television. Good morning.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
breaks. No one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of 3 very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
Bloomberg Surveillance on radio and television. Thank you for joining us through the week. Just a major shout out to our booking team for a great, great job. And all of that centered on a Friday of economic data. And we're going to see that coming out here in moments. He is in Washington with the NABE preparing for his interview with Susan Collins of the Boston Fed. That's going to be a really important interview today. And out with the data here at 8:30 are Michael McKee. Mike, what do you see as we begin to see the data stagger across the screen?
Staggering is the way it is these days now that people have to all click on the internet at the same time. First numbers we get are personal income and spending. Personal income comes in higher than anticipated, but certainly down from the month of January. It's up 0.3. In January, it was up 0.6. Now, this isn't a complete surprise because, of course, in January, you get minimum wage and salary increases and the Social Security COLA. So not a major issue there, but it's consumer spending that is a bit of a problem. Rises only 0.2% after a 1.8% gain in January. We've heard from credit card companies recently that they see spending momentum dropping, and so that's something that we need to keep an eye on. We'll certainly ask President Collins about that. The inflation numbers that we care about, the personal consumption expenditure index comes in up 0.3 for the month of February. That is exactly what was forecast, half of what we saw in the prior month. That moves the year-over-year number down to 5%, a little bit lower than anticipated. The core comes in up 0.3%. That's lighter than the 0.4 expected, and certainly down from the 0.5% we recorded in the month of January, pushes that number down to 4.6% on a year-over-year basis. So inflation slowing, but the economy also appears to be slowing in these numbers.
We're going to come back to Michael McKee as he takes a pause to further digest the voluminous data coming out. We're going to digest the data check, which clearly shows a lower rate regime. That 2-year yield up near 4.16 earlier, now 4.0976. I'm going to call it a 6 basis point trend of a lower 2-year yield. The 10-year yield 3.53%. Equity markets like what they see. Bramall all on top of her leveraged NASDAQ play, up 32 points on the NASDAQ, 13,119. Standard & Poor's up 16 points. Michael, I want you to, before we get to Matt Lazzetti here, set up the distinction of the revision in the month-over-month core and the year-over-year core. They tell two different stories, don't they?
Yes, when you're at the Fed or looking for what's actually happening in terms of sequential progress on inflation, you're looking at the month-over-month data because it tells you what's been happening in the most recent months as opposed to what happened compared to a year ago. And we know there were completely different circumstances a year ago. So everybody's looking at that number that is just this month, and they do come in lower than anticipated for the core especially. So that's good news for a Fed that's looking for progress against inflation.
Michael McKee, thank you so much. In minutes with Susan Collins of the Boston Fed. Joining us now and all timely is Matt Lazzetti. He's chief U.S. economist at Deutsche Bank, who had a shocking call long ago and far away of economic slowdown, but was emphasizing it would be out there somewhere where so many others were looking for immediate economic slowdown. We recalibrate this morning with Matt Lazzetti. I guess we see disinflation out there. Can you establish off this data disinflationary vectors in goods and services?
Yeah, I think we need to put the disinflation into context. It's still a 0.3% core PCE, month-on-month print, still well above the Fed's objective. 4.6% year-on-year is well above the Fed's objective. We were expecting this to be a bit softer than CPI, in part because airfares were much weaker in the PCE data. We'll have to see what we get in the core services ex shelter, which has been Chair Powell's main focus. But I think what we'd see from this data is a little bit softer than expected, but still well above the Fed's objective.
Still, to Mike's point, I mean, this is basically inflation perhaps not as hot, but growth also slowing perhaps more than people had expected. At what point does that story start to get priced in more? In other words, not exactly supportive of this robust, we can make it through anything kind of narrative.
Yeah, we saw it yesterday with the GDP revisions. Consumer spending revised down. Basically, the domestic economy didn't grow in Q4. We have an alternative version, GDI, was actually negative in Q4. So I do think you have some evidence of slowing in the economy. We have to be cognizant you had a lot of strength in January, and so a lot of this is a give back to that. I think it all comes down to the labor market. Do we eventually begin to see that to soften? Do we eventually begin to see employment gains slowing? Unemployment insurance rolls picking up? I think that's the key question from the Fed's perspective.
A lot of people are wondering whether the Fed's going to cut rates later this year in the face of whatever weakness right now materializes later as a greater weakness. How is the response going to be at a time when you do say that inflation is well above their targets? They need to bring it down, but it is going down, and a lot of people think it will continue to do so as time grinds on.
Yeah, I think, inflation is obviously well above their objective. The way that Chair Powell has been talking about the labor market is it's either extremely tight or tight to an unhealthy degree. And so there's no difference in or tension in their dual mandate at this point. I think the real issue comes when that tension arises. We think it begins to arise this year as you see the unemployment rate begin to increase at a time where inflation is still well above their objectives. Their own forecast at the end of this year have 4.6% on the unemployment rate, about 3.6% on core PCE, and them not cutting at this point. We expect that they cut rates in January, but a lot of it depends on how this credit shock plays out. Certainly it could mean that the recession's earlier, labor market weakens earlier, and the Fed has to cut earlier.
Susan Collins will be with us in 10 minutes with Michael McKee. She's absolutely definitive academics, as are you, from UCLA, and she has a Harvard, MIT heritage, and she's been at Michigan, and Michigan has a cottage industry of studying inflation and price change. When they debate at the Fed, and whether voting or non-voting, when Susan Collins leans forward and talks about inflation, does she talk about the same inflation that Peter Hooper talks about, or that Mohamed El-Erian talks about, or that Lau Brainerd talks about? Is everybody on the same page on what to look at?
Yeah, I think her speech yesterday was very clear. She broke down the basket into the three components that Chair Powell has been emphasizing: core goods, shelter, and core services ex shelter. I thought what was most interesting from her comments yesterday is she used a language about rate hikes that was a bit different than the statement. She said that additional tightening will likely be necessary, not may, which is what the statement indicated. I thought that was a firmer indication of another rate hike, at least at the May FOMC meeting. That's our base case at the moment. But I was surprised about that.
I opened the Quinnipiac Game Forum yesterday with the slew rate of this rate rise. It's just incredible how quick we got here, and in hindsight, maybe too quick. What's the efficacy of a pause? When you at Deutsche Bank sit around and say, lift, cut, or pause, to me, a pause gives you optionality. Am I wrong on that?
No doubt it can, but I think it's a multifaceted question. If they pause, what does the market do in response to that? We have a market that has been pricing rate cuts earlier than the Fed has wanted. If they pause, what happens with that? I think rate cuts come much sooner and earlier, and I think that's a difficult dynamic.
They can't pause and say, we're just pausing to see the data, even if we think it's going up.
I think it's very difficult for them to pause and not pull forward the market's pricing of rate cuts.
Key.
I'm a bit distracted over here because I'm trying to understand this market movement, and it basically seems to say a soft landing looks more certain after this data comes out. What's your take on that? I mean, do you think that what we have seen from the data, from the response mechanism, from central bankers, that we're heading closer or further away from a soft landing?
So I think it all depends on how you're viewing this credit shock. We think it can be material, but to be quite honest, at the moment, it's speculative because we don't have data on how it's playing out. We're looking towards the Fed Senior Loan Officer Survey in early May. Everybody is. We're looking at the H8 data later today to see what's happening with C&I loans, CRE loans. What we saw out of the Fed's balance sheet data yesterday was supportive. It's things are not getting worse. We saw an aggregate reduction in their lending facilities so far. But we do think that credit conditions are going to tighten. The way that we've tried to quantify it suggests it could be anywhere from 0.5% on growth to certainly more than 1%. But at this point, it's difficult to gauge. If that does tighten, I think it certainly means hard landing is more likely than even we were anticipating.
Moments ago, Lisa, oil, $75 a barrel. American oil from that 69 level up to 75. Just an example of this correlated lift away from all the gloom.
This feeling we're going to make it through. I mean, oil has been its own animal with a lot of other specific stories, but there has been this feeling we will get through. And if there is some sort of downturn, it will be short and shallow was the theme. And now it's maybe we won't get one, the no landing, and maybe we're back to that. Do you still believe that if we prolong some sort of recession, it will be a worse recession?
Not necessarily. I think the way that we typically think about this is imbalances can build up the longer that this goes on, and therefore the recession can be deeper, more protracted as you have to delever. This time around, we haven't seen the imbalances being built. You have household balance sheets that are in very good shape. You have a housing market that is already going through the correction. We haven't seen overbuilding certainly take place there. So our view is still that this is a moderate recession. It looks a lot like the early 1990s. We've always thought it happens in the second half of this year and haven't really changed that view. I think it's consistent with what we're seeing. I would not say that just because we got a 0.3% on core PCE that we've shifted to a soft landing type narrative here. Inflation is still well too high for the Fed's liking.
Equities lifting here as well, and the 2-year yield comes in 4.10. We're looking at the 2-year, folks, just because of the banking crisis. It's got some more information than 3.52 on the 10-year yield. Let's review your home run call. You came out and said recession. Everybody got all bent out of shape, but what you really did is said recession in late 2023. How do you nudge that out? What economic data would force you to move your recession call that's been fabulous into 2024?
Yeah, I think it's, again, all about the labor market.
The jobs,
and what are you seeing? And not only because it's, if you see the unemployment rate rise, it's always shows a recession is happening. But the labor market tells us about the underlying strength in the consumer and household. And so if we're producing strong wage gains, strong income gains, the idea that the consumer can remain resilient in the recession further off is the key question.
I mean, it's a Luzetti statistic. I missed it yesterday because I was doing the Quinnipiac thing. Claims 191 to 198.
Yeah.
I mean, there's a trend for you.
Yeah, right. People were saying it's the first increase in months. Well, yeah, it still is below 200,000, and it's nothing to really get alarmed about. And this has been the problem. You're not seeing it yet in the key metric of the labor market that we're looking for that will signal to the Fed that we're seeing some real weakness. Matt Luzetti, thank you so much for being with us. I really appreciate that. We're going to carry this conversation forward, Tom, on the open. I'm heading over there. I'm leaving you.
Are you taking Luzetti so you can review Steve Cohen's baseball team?
Yeah, we're going to go just join together in our Mets fandom. Coming up on the open
Mets
with Bob.
Marlins this afternoon.
Correct. Hopefully they'll make it a two-game streak. Bob Michael of JP Morgan joining us next. Victoria Fernandez of Crossmark. David Balin of Citi.
Wonderful.
And Terry Haynes of Pangea Policy. That's all coming up.
Great
on the open.
lineup there. Do you know Victoria Fernandez follows the Dow Jones Industrial Average?
I heard that.
For sure you bring
I heard
it up
that,
with
yeah.
her. Susan Collins and Michael McKee next. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. History has been made as Donald Trump becomes the first former U.S. president to face criminal charges. Manhattan grand jury has decided there was enough evidence to move ahead with the case against him for his role in paying hush money to a porn star during the 2016 election. Trump's lawyer said he could be arraigned as early as Tuesday. Trump disguised the case as the latest effort by Democrats to destroy the Make America Great Again movement. The Biden administration is going to unprecedented lengths to play down the importance of Taiwan President Tsai Ing-wen's visit to the U.S. It's an attempt to keep the relationship with China from getting worse. People familiar with the matter say Beijing's unhappiness may be more muted than expected. Tsai scrapped some events in the U.S. and limited her press engagements. In the euro area, inflation fell by the most on record, but a core inflation set a new high. That highlights a tricky task facing the European Central Bank as it decides how far to lift interest rates. Consumer prices were up 6.9% in March from a year ago, down from 8.5% in February. Core inflation, which excludes volatile items like energy, it rose 5.7%. And satellite launch company Virgin Orbit is ending operations indefinitely. It's succumbing to growing cash crunch pressures that have paralyzed startups. Virgin Orbit is cutting 675 jobs. That's about 85% of its workforce. The company is tied to British billionaire Richard Branson. It had a high-profile launch failure in January. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
The banking system is sound. Banks, on average, have a lot of capital. The Federal Reserve and the other banking regulators are standing behind the banking system. It's going to probably take us a while till we fully understand, are there more losses out there? The other thing is, what's unclear right now is how much of the banking stresses of the past few weeks is leading to a sustained credit crunch, which would then slow down the U.S. economy.
Neil Kashkari of the Federal Reserve Bank of Minneapolis there, showing the strength of the American Federal Reserve System, each district of itself. Right now, and we're going to do this quickly because every second matters with Susan Collins, it's very simple. She is associated with the University of Michigan, but far more, her sterling academics that we've seen from Susan Collins at Harvard, and then deep down the Charles River to MIT. And of course, as Michael McKee goes, plunging across to near South Station in the Federal Reserve Bank of Boston. Michael McKee with Susan Collins.
Thank you very much, Tom. We have the Boston Fed president here with us in Washington, and we'd like to thank you for joining us today here at Bloomberg, and to our audience around the world on Bloomberg Radio and Television. Thank you for joining us. Let's start with the numbers because they just came out. Personal income up 0.3, personal spending 0.2, and then the PCE indicator, which of course is the Fed's favorite, 0.3 for the headline, 0.3 for the core. What does this tell you about the state of the economy and where the Fed is in its inflation fight?
So let me start by saying just absolutely delighted to be here with you. Look forward to our conversation. And of course, I haven't had a chance to dig deeply into the numbers yet, and sometimes the details actually are important in terms of understanding the story. But starting with the PCE inflation, that's about what was expected. And so that is some positive news. At the same time, let me say two things about that. One is that the monthly data are really noisy. We've seen that. And so 1 month of move in a kind of more helpful direction is not something that really indicates a sustained change. And the other thing I'll say is that if you recognizing the elevated numbers we saw in December and January, this a bit lower number that we expected just means that the 3-month average is about what the 12-month average is. And so that's not a lot of progress. We still do have more work to do and more to see to know that inflation is really on a sustained downward path.
Well, you're on record as saying you favor at least one more move by the Fed. Does this sort of lock it in for May that you do it because inflation is still at a high level and you don't pause for a month to see how things are going?
Well, actually, what I think I'm on record as saying is that I'm highly data dependent. And so my assessment at the last meeting, just last week, with the summary of economic projections did suggest an additional rate hike and then pausing and holding over the year. But I need to assess all of the data that's going to come in between now and when our next meeting is in early May. And, you know, where I am at the moment, the new data that I've seen just in the past week has not materially changed how I'm thinking about things, but I certainly don't make a decision this far in advance about what I'm going to think is the right thing to do.
Well, the markets have looked at all the data, and they're pricing in 4 rate cuts this year. Are traders crazy?
What I would say is obviously there's a range of views about these things. I mean, look, inflation is just really too high. When we talk about price stability, to me, what that means is a level of low, stable inflation where no one's thinking about inflation. Well, everybody is thinking about inflation, and that really does mean we have more work to do. And what history has told us is that you need to have conditions sufficiently tight and then really hold the course in order to know that you have, in a sustainable way, gotten inflation going back to what the target is.
Well, spending was down during, not down, but it decelerated significantly during the month of February, according to this report. Do you worry about going too far and tipping the country into recession? That's the standard view of what the Fed does.
It is absolutely a balance, and I think it's important to recognize that there are uncertainties, there are risks, and in particular, we do need to balance the risk that we don't do enough, that we're not sustained, don't hold the course, and don't bring inflation down. And again, as I mentioned before, inflation is really costly to businesses and households, and so that's important. At the same time, you're absolutely right. I do monitor the data, looking at when we might see the economy turning, and some of the slower data I think is helpful in that context. That's what we would hope to see. At the same time, early days yet in terms of assessing whether we really have gone as far as we need to go.
Well, in terms of assessing, have you got any assessment of what impact the recent banking issues will have on the economy? There's a theory out there, banks are going to tighten credit and do some of your work for you, and that could also send us into recession.
That is certainly an important factor. There's absolutely a theory out there, and we could see some of that. My expectation is that we're likely to see at least some, but we'll have to continue to really monitor the data and see what happens in terms of how things evolve. But, you know, as I've said, I had expected early in March that I might think we would need to do more work, and the banking stresses and what I think is at least a possible response of banks in terms of their own liquidity needs has influenced that. And so it's certainly one of the important things to factor. You know, one of the things I do want to just emphasize is I continue to see, given the resilience in our economy, that there's a pathway that we can bring inflation down without a significant downturn. And so monitoring holistically the range of data and that balance that we just talked about is a really important factor in that outlook.
Do you think the Fed bears any responsibility for what happened with the banks because they raised interest rates so fast and so far?
I think that there were a number of mistakes and challenges that were made. I also think it's really important that the review that Vice Chair Barr is conducting, that's underway, be thorough, unfettered, and that we not kind of prejudge what the lessons and findings from that report are going to be, but we commit with a bit of a sense of humility that we will take those findings really seriously and act on them to continue to strengthen what I see as already a sound and resilient banking system.
Well, what are banks in your district telling you about their situation?
So, of course, we monitor very closely, and we are in close contact with the banks throughout the first district, which is most of New England. And what we're seeing is that they are very focused on the their activities to really support the communities throughout our district. As you know, small and medium banks play a critical role in a vibrant economy, and they also, are particularly focused on what some of the risks might be, especially in the aftermath of some of the stresses that we've seen. And so we are particularly focused on what some of the risks might be, especially in the aftermath of some of the stresses that we've seen. And so we very much work to support those activities and appreciate the work that they're doing.
You and your colleagues talk a lot about the cumulative impact of your rate increases. Is that hitting now? Has that hit? When do we really see 5% Fed funds rate have an impact?
Yeah, so that's a really important question. And the way that I think about it is that there are absolutely lags. There's some sectors, some parts of the economy that see the increase in rates and they respond relatively quickly. And I would put housing markets there. We certainly saw responses in housing markets to tighter financial conditions relatively quickly, and that's what we would expect. At the same time, other markets, such as labor markets, often are impacted over time. And it really is only in the second half of 2022 that our interest rates got to a broader range that were quite restrictive. And so my assessment is that it will still be some time, but over the coming quarters, we really should see other sectors of the economy respond to the tightening that is already kind of factoring through the system.
Well, I guess we'll check back with you in the fall. One last question, Tom Keene. Since I know the Red Sox lost yesterday and you're on record as saying that the season is over, let me ask the Boston Fed Bank president, one loss, is the season over for the Red Sox?
Absolutely not. And we look forward to our Red Sox and our other teams having a wonderful season and many exciting games ahead.
All right, Tom, somebody
She
for you to
nailed
debate
that.
with.
She absolutely nailed that. Michael McKee last night with a Pasternak jersey on, Justin Turner of the Los Angeles Dodgers forever, the new Boston Red Sox watching Susan Collins' Boston Bruins last night as they stormed the National Hockey League. Michael McKee, the meetings of the National Association for Business Economics. What are you doing up here? We're watching equities lift, futures up 9. We almost got to 4,100 on S&P futures. Stay with us. This is Bloomberg.
Our studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
Chris, can I ask my landlord for a rent cut in the next couple months? Like, is that reasonable?
Well, I guess it depends when you signed your lease, Joe. It sounds like you got kind of one of those pandemic deals that, particularly in New York City, where rents actually fell really sharply in that first year of the pandemic. So we are really seeing the market having turned a corner a little bit over these past few months. Prices have been coming down for 4 straight months now in our national rent index.
Wow.
But, if you're still paying that late 2020 level, then you might not necessarily be eligible for a discount at this point.
Good point. All right, I have another question, which is like, so I have 2 kids, but unlike other people, I actually am cool and I don't want to move to the suburbs. Like, I want
This episode is just Joe taking advice on handling his rent.
I just want to point out, I really like my landlord.
You love your landlord?
She's very attentive. We have a very good relationship. So even though I started the episode saying I was anxious, if she is listening to this, I hope she hears that I really enjoy where we live and I really enjoy our the landlord.
She should factor your consistency into her pricing algorithm.
We've never been. Yes, exactly.
Excellent.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
From New York City, for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. A bit of calm to end a quarter of incredible gains, the best quarter for the NASDAQ, going back to the height of the pandemic. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, looking to close out a crazy Q1 with a quarterly gain. The Fed's emergency loans to banks point to stabilization, and Trump becomes the first former president to be indicted. We begin with the big issue, closing out the first quarter.
This year has all been about the whipsaw.
The volatility, I got to tell you, it is pretty crazy.
The bond market is the place where you see the volatility express itself.
The volatility that we saw in two-year yields over the last couple of weeks.
Two-year yields went from 5 to 4, and 10-year yields went from 4 to 3.5. It's whiplash.
We've had a series now of problems.
3 banks having been shut in the U.S.
Stories about Credit Suisse, stories about Silicon Valley Bank.
Not only do you have the banking crisis that's weighing on confidence.
When you think about the Fed and all of these, they've still got a big inflation problem.
Markets and Fed are playing a game of chicken.
Whether it's rational or not doesn't really matter.
A lot of sentiment and a lot of kind of, emotions.
Pretty amazing.
We have never seen anything like this.
Joining us now to discuss Crossmark's Victoria Fernandez and Citi's David Balin. There is the key question, if we were going to rewrite our year-ahead outlooks now versus January 1st, Victoria, would you feel more confident or less confident about the road ahead?
Well, Lisa, I think, maybe 6 weeks ago, you and I spoke, and I was saying that we were confused about what was going on. Things weren't making sense to us. We didn't like the difference that we were getting in messaging from the bond market and from the equity market. And so if we come to where we are now, I feel like we're still there. We're still in that confusion. I've been calling it a foggy windshield where we don't have a clear vision of what's going ahead of us. And I think it's still part of that. The bulls are going to be frustrated by the things that they know are more bearish in the market, and the bears are going to be frustrated by a stronger consumer, by the idea that the Fed is done, and so these more bullish risk-on moments in the market. And so I think there's still this tug-of-war going on here, and I'm not sure that we're going to be able to get a very clear picture until after May. If the Fed says at the May meeting that they're done hiking rates or that they're at a pause, then I think you get a little more risk on and you can write that story a little bit better. I'm just not sure that's the story that we're going to get. So for us, it's more volatility for the rest of this year. Same story we've been saying this whole quarter.
David, do you agree that we have to wait until May to have any clarity whatsoever, so we should just go back to sleep and wake up then?
No, I actually don't agree with that. I think that we actually have some clues right now as to what's going on. And those clues are in the bond market, right, where we've seen rates, come down precipitously. Part of that is associated with the banking crisis, right, and all of the rush to quality. But the divergence between, what's happening in the bond market, which tells us that a recession is more likely, that a slowdown is more likely, and the equity markets, which have stayed robust, I think is pretty considerable. And the evidence leans toward, that recessionary outlook. And the reason is that earnings projections are just simply too high for the environment that we're in right now. We think that we are probably seeing earnings estimates that are 10% or more greater than they should be. and that leadership in the market, in particular in equities, is really limited to the very, very largest firms, the highest quality names, and is not broad enough to make us feel confident that equities are in fact properly priced.
We'll get into exactly which areas you think are most mispriced, but honestly, a lot of people are pointing to smaller businesses, particularly with all the money that's been flooding into money market accounts. Barclays seeing another wave of bank deposit outflows, writing, recent tumult regarding deposit safety may have awakened sleepy depositors and started what we believe will be a second wave of deposit departures with balances moving into money market funds. They go on to say, we expect flows into money funds to grow by several $100 billion, heating up bank deposit competition. Meanwhile, we are seeing that deposit figure rise to $5.2 trillion of money markets outstanding. This really bleeding into this concern of what that means for lending. So, Victoria, from your perspective, how much are you watching smaller businesses as the most vulnerable in this type of environment?
Yeah, that's a great phrase to use, Lisa, the most vulnerable. And it does come down to these lending conditions that we're seeing right now, because we know as lending standards get tighter, as we get fewer loans coming in, that's M2 growth that continues to decline. That makes a contraction in the economy, and it flows through to some of the things that David was talking about. It flows through to earnings for corporations, because when they start to get tighter margins, what happens? Well, they're going to lower headcount, and so then that's going to flow through to the labor market, and we're going to start to see some of that shift as lending standards continue to get tighter and as loan growth goes lower. And so I think that's going to be a key factor to watch. We know that small businesses are the driver of this labor market and the driver of our economy. So it's going to be very important to watch. But I think we also need to watch what some of the larger corporations are doing in regards to issuing debt. You were just talking about yields coming down and rates coming down. We saw spreads widen tremendously. But over the last week, we've actually seen those tighten up. About 50% of the widening has already come back in. So I think there's a lot of different clues that we can look and see how the economy is going to look going forward.
David, you mentioned earlier you don't think that stocks have accurately priced in some of this softening, some of this restriction in credit. Which areas of the equity market do you think are most perhaps mispriced?
Yeah, well, I think it goes along two dimensions, right? One is company size, and one of the our industries, right? So if you take a look at industrials and metals and materials, for example, you could see real deterioration there. You could also expect to see deterioration in small and medium-sized companies, and the reason is that they're going to have to pull back, right, on their actual capital investment, across the board, and that is going to cause there to be just simply less spending, in those smaller businesses. And so for me, this is an area where when you combine all of these factors, right, the actual fact that the banking impact has been on small and medium-sized banks that'll reduce lending. When you take a look at the actual areas of the economy that are least likely to grow, and Victoria's right, where we're going to actually see job cuts. We've seen 300,000 job cuts announced in the information technology space over the course of the last 3 months, and those people have yet to come off of their severance pay that they're going to get before they become unemployed. So there's a lot of these factors that suggest that these weaker parts of the market, small and medium-sized companies, are yet to really report that their earnings impact.
The sort of mystery soup that we're talking about has created quite a conundrum for Fed officials who continue to speak and express their concern about what's happening, but really lack particular wisdom or insight into the road ahead. Boston Fed President Susan Collins speaking in an exclusive interview with Bloomberg's very own Michael McKee. Take a listen.
My assessment at the last meeting, just last week, with the summary of economic projections, did suggest an additional rate hike, and then pausing and holding over the year. But I need to assess all of the data that's going to come in between now and when our next meeting is in early May. The new data that I've seen just in the past week has not materially changed how I'm thinking about things.
We have more with our own Michael McKee. Wonderful interview. And I've got to say, Mike, it's really notable to see the shift in tone. Frankly, the humility, the lack of certainty, and the data dependency at a time where we're not sure which data matters most.
Yes, and she pointed that out, that it's going to be difficult to make decisions because the data are lagging and they are all over the place. Let's look at some of the data that we got today that we talked about during the interview. Personal income up 0.3%, half of what it was in January, and spending only 0.2%. Susan Collins saying she was expecting the economy to slow. That's what the Fed is trying to do, so it may not be too bad a news. Excuse me a moment. The PCE headline numbers, half of what they were on a monthly basis, both headline and core, up only 0.3, which would suggest progress, although she said that it is hard on a month-to-month basis to say that this is a definitive trend because the numbers are somewhat noisy. And then, Lisa, of course, we have the Fed's favorite indicator, Jay Powell's PCE core ex-housing index, and you can see there was some progress made. The month-over-month number is only up by 0.3 rounded off, and that keeps the year-over-year number elevated, but not as bad as it had been in prior months. So we're looking at some progress there. The one interesting thing, of course, is that the markets are still pricing in 4 rate cuts this year, and I asked Susan Collins about that, and she said different people have different views. We'll have to see if that bar chart changes or flips direction as time goes on, but she said she's committed to keeping interest rates at a high level throughout the year, at least unless the data tell her something different.
Yeah, she was keeping the line. That's basically kind of what we heard from Fed Chair Jay Powell, that wasn't his view, or it wasn't Susan Collins' view. Michael McKee, thank you so much, and really wonderful interview. Don't miss Mike's follow-up exclusive interview with St. Louis Fed President Jim Bullard on Monday. That's 8:30 a.m. Eastern on Bloomberg Television and Bloomberg Radio. This question around a market that is convinced of rate cuts with a Fed that still wants to perhaps pause rate hikes, but really hold right there, really has posed an issue for markets. Victoria Fernandez and David Balin still with us. David, how much do you lean into this view that the Fed is going to cut rates by the end of this year? And does it matter? Because either way, it means that there's either a deterioration in the economy or strength in the economy, one way or another, and it's not necessarily all about the Fed.
Well, in many ways, it really is, all about the Fed, because when you listen to Susan's interview, which was excellent, I think that, one of the things that was sort of unsaid is that the Fed has been unable to keep peak rates for more than 7 months at a time. And the Fed's ability to tolerate unemployment is very low. Even during the Volcker era, that was the case. So what we expect to see is when we finally see a deterioration in employment, the Fed, I think, is going to be very inclined to become more accommodative based on historical precedent. If they don't choose to do so, what we're also not saying is that when you look back, it takes 12 to 18 months for the full impact of Fed policy to actually hit us. And we're actually in that time right now. They began these extraordinary rate rises, more than a year ago, and we're about to get the full impact. I describe it this way: 2 Advil for a headache, 4 Advil for a migraine. When you take 16 Advil, right, you could have side effects. And that's what we saw with the banking crisis, and we're likely to still see, that rates have never gone up this fast in history, right? 4 3/4 of a point, hikes. That is highly unusual. And so the idea that we're going to have this soft landing, that everything's going to work out okay, seems a little suspicious to me, and a little suspicious to the bond market. That's why I take the bond market's pricing in not necessarily the timing of the rate decreases, but the fact that they will occur. I believe that they will occur, and they will occur once we have employment really deteriorate, which is what's in front of us.
Victoria, your view?
Yeah, so I look at what the Fed has said to us, and I look at what Susan Collins said, and I'll be anxious to hear what Bullard says next week as well. And they're telling you that they still think there's more work to do. So all along, over the last year, the market has not believed the Fed. They have lost confidence in the Fed. They wouldn't listen to what they were saying. And as Powell and the Fed continued to do things, the market seemed to come along a little bit. So yes, the bond market has priced in rate cuts at the end of this year. I'm just not 100% on board that we're going to see that. I think we get a mild recession coming in maybe third quarter of this year as all of these previous hikes work their way through. Yes, we do have those long and variable lags that we're waiting on, but I don't think the Fed is going to be quick to cut rates. They have had a long battle trying to get inflation down. I don't think they're going to flip that switch as quick as the market is pricing in right now, and we'll probably see some of those rate cuts get priced out of the market, giving us higher yields as we get closer to the end of this year. I do think we'll see rate cuts next year. I think we'll have a mild recession. The Fed will eventually cut rates. I just think the timing is going to be a little further out than what the market's anticipating right now.
Victoria Fernandez, David Balin, both of you are sticking with us. Joining us now with a look at the stocks moving ahead of the opening bell. Here's Katie Greifeld. Katie?
Well, you have stocks linked to former President Trump absolutely soaring this morning. Let's start with Rumble. It's a video sharing platform with a conservative bent. It happened to report earnings yesterday that beat expectations. All of that is lifting the stock. And of course, we have Digital World Acquisition Corp. That is the SPAC that's taking Trump media public, also surging up about 8% or so. Definitely just a few of the names to keep an eye on next week, with Trump expected to be arraigned as early as Tuesday.
Katie, thank you so much. Coming up, former President Donald Trump indicted.
I think this is an outrage. This will only further serve to divide our country.
That conversation, as well as the potential policy implications, coming up next.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Are you worried this will further divide our country, the indictment?
I have no comment on that.
Mr. President.
Possible protests in the wake of the indictment?
No, I'm not going to talk about Trump's indictment.
Donald Trump becoming the first former U.S. president to be indicted. The arraignment coming as early as next Tuesday. The specific charges, however, are still under seal. The former president calling the indictment, quote, political persecution and election interference at the highest level in history. Lawmakers are already taking sides. Speaker McCarthy saying it's, quote, an unprecedented abuse of power. Democrats welcoming the news. Representative Maxine Waters tweeting, quote, sometimes justice works. For more, Bloomberg's Anne-Marie Hordern joins us here in New York. Anne-Marie, how much is this really dominating the conversation in Washington, and how has it changed the narrative as it had been going?
Well, Lisa, what really it's doing is just pulling the oxygen out of any conversations you're going to have about policy or anything regarding the debt ceiling, negotiations that are ongoing right now. You saw the president walk down a line of reporters, and every question was about former President Donald Trump. And you could see that that is going to be every single question, whether it's at the White House or in Congress. So that's where the focus, of course, is, because as you mentioned, this is unprecedented. And not only is Donald Trump a former president, he's also a 2024 presidential candidate. And that is why you're going to see really party lines harden because of this. And not just party lines in terms of Democrats and Republicans, but I also think this is going to have further division within the Republican Party. The former president has about 30% of the Republican Party, and this kind of moment is something he revels in because already he's able to go out there, say that he's a martyr, really pump up his base. He's talking about protests because of this, and of course he's asking for campaign aid finance dollars off of this.
Anne-Marie, just quickly here, Joshua Green wrote a terrific piece for Business Week talking about how there really isn't a corollary in the U.S. history, but there are corollaries in the world, including, for example, people in a number of developing markets, leaders who do not step away from allegations but lean into them. Internationally, is there any sense of how this shifts the conversation?
I think what you hear, especially from the likes of European allies, you saw the former president, Donald Trump, take a very U.S.-centric push into foreign policy world. And that whether that was China or the Middle East, what you see President Biden do is they really want a multilateral approach, not unilateral. And what European leaders are concerned about is potentially if the former president does become the GOP candidate and potentially wins, how they have to shift after they built up all this, almost more of a teamwork approach with the Biden administration. There are those concerns.
Anne-Marie, thank you so much for all your reporting throughout the morning, and we'll look forward to it this afternoon. Victoria Fernandez and David Balin still with us. From an investing standpoint, how much, David, is this just noise, and how much is this something that you have to take into account that could potentially affect, if nothing else, currency landscapes and international relations?
Well, I think that the big concern is really not so much this, the indictment, so much as the question of what happens around budget negotiations and the debt ceiling. We tend to downplay, because of all the historical precedents, the fact that this will get resolved properly, and we certainly hope that it will in markets. But there's no current pricing that, that it really assumes that there'll be a default or even the threat of a default in markets right now. And the politics associated with these events can, in fact, spill over and be expressed through the debt ceiling issue. So that, to me, is the largest risk that they tie one to the other.
Victoria, do you get that sense that there could potentially be some greater pressure, some greater risk that there is a debt ceiling debacle, a debt default that does become really important to markets?
Well, obviously, the debt ceiling issue is going to be important to markets, and we've heard a little bit more this week about some compromises potentially. The Republicans are putting out some ideas that they have. President Biden had put out his ideas, so we'll see if they're able to come together, if McCarthy and Biden can come to a conclusion there. But it's going to be a long, drawn-out battle, and I think we're going to go to the brink. I think we'll probably actually cross over the X date that we're given, which right now seems to be somewhere around July or August. I just think there's going to be a tremendous amount of partisanship that is going on, and I think the Trump indictment is going to fuel some of that as well, and that's going to push us to the limit. That's where we're going to get volatility in the markets. That's where we're going to get concern on the dollar. I wouldn't be surprised if we saw rating agencies come back in again like we saw previously and have some discussions on what that means. So I think there could be potentially a lot of volatility within the markets due to the debt ceiling, but the Trump indictment just adds to the fuel of the partisanship associated with that, when I was actually hoping we might get some cooler heads prevail and come to an agreement. Doesn't look like we're going to get that.
And this really speaks to something that Mark McCormick over at TD Securities has been talking about, how much of the decline in the dollar, the weakness that we've seen so far this year, and certainly even over the past turmoil, is due to a lack of U.S. exceptionalism. David, do you believe in that story that some people are putting out there?
Well, I don't think it really has anything to do with a lack of U.S. exceptionalism, as it does to the fact that this is the third, largest rally in the dollar that we've seen over the last 50 years. And that rally is coming to an end for structural reasons and other reasons. And I'll give you two. One is, right now, when we saw the banking crisis, we did not see the typical rise in the dollar, which we would normally see, because of the fact that the dollar was already so expensive. And then secondly, when we take a look at what's happened overseas, the European banks themselves are far healthier, have a better deposit ratio than we see in the United States. And all of this suggests that the U.S., is at peak interest rates and the peak interest rate differential to the rest of the world, and that we're actually now going to see, a reversion to the mean for the U.S. dollar, none of which I think is really related to the political events that are taking place right now or the end of U.S. exceptionalism in any way.
David Balin, Victoria Fernandez, to both of you, thank you so much and have a wonderful weekend. Just want to give you a sense of where we have been in this quarter as we get prepared for the opening bell. The tech stocks are poised for their best March since 2010. Tech stocks are the best quarter since 2020. Yet bank stocks, the biggest laggard, are wrapping up their worst quarter since 2020. Coming up, the morning calls, and later, the case for duration, why JP Morgan's Bob Michael is doubling down on government bonds, even the longer tenors. That conversation happening around the opening bell. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. A constructive tone to end the quarter, taking a look at a potential 0.4% gain in the S&P. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Citigroup calling McKesson its top pick in the pharma sector, expecting shares to act as a safe haven in a challenging environment. Next up, Barclays upgrading advanced auto parts to equal weight, highlighting the stock's notable underperformance. And finally, Loop Capital downgrading JD.com to hold, growing more concerned about the highly competitive e-commerce landscape. Coming up, stocks closing out a volatile Q1 with another quarterly gain. We've got JP Morgan's Bob Michael joining us at the opening bell on his call for potentially the entire yield curve below 3% in the next 6 months. This is Bloomberg.
most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of trading with a constructive tone to markets to end a very constructive quarter. Some of the best and some of the worst quarters since 2020 for a number of different asset classes. Russell doing better than good, up 0.7%, as you've got that bank sector really supporting it. S&P futures up about 0.25%. In the bond market, a constructive tone, although it's sort of not a lot of drama after a pretty tumultuous a couple of weeks. We can have right now the euro weakening versus the dollar. 10-year yields 3.5%, and crude marginally higher here as people take a look at the potential for maybe a soft landing, maybe faster growth. I can never figure out the crude market, and I don't think a lot of people can right now. One sector to watch at the open is big tech. The NASDAQ 100 closing out its best quarter since 2020. For more, Bloomberg's Ed Ludlow joining us now from San Francisco.
Yeah, good morning, Lisa, and happy Friday. Best quarter since that June quarter of 2020, but the second best quarter overall in the last decade. You look at the contribution of mega cap tech, that's a really interesting contribution, in part because many of those names that have had strong performance, particularly in the back end of the quarter, are trading at multiples and forward 12-month earnings above the NASDAQ 100. In fact, it's only Alphabet, parent of Google, that's trading at a discount to the main index right now. I think there is some concern. You referenced the Goldman Sachs note of 24 hours ago. We're still asking ourselves what happens if we go into a recession. And if we go into a recession, what happens to growth names in particular that are low margin or profitless, and how we might value those, because then growth expectations going forwards will come down. The mindset around the Fed also seems to have changed when we talk about the technology sector. Reading across the research this week, we've kind of moved on from the rates narrative. We accept that higher rates discount the present value of future profits, but we also look at the impacts of the Fed's balance sheet and what they've done from an easing perspective over the last 7 days or so. That relationship at the short end, the policy-sensitive end of the curve, and the NASDAQ 100 still important. We still track it. One other data point that I want to pick out in today's Tech Watch column: investors have been piling into tech. Those that have been fleeing tech are insiders. If you look at the data tracking insider share sales, you have to go a pretty long way back, the end of 2021, since the flight in executive share sales within the sector are that high. Final chart there on your screen shows the lingering impacts of SVB. Look at the Goldman Sachs non-profitable tech basket, the white line, and its underperformance of the kind of more premium names in the S&P 500 tech sector. Good quarter, though. What did you call it? Constructive quarter.
Ed Ludlow, thank you so much for that. Banks, as you mentioned, Ed, going in the opposite direction with the KBW Bank Index set for its worst quarter since 2020 after snapping a 4-day winning streak. Katie Greifeld joining us with more. Katie?
Yeah, not quite a constructive quarter if you look at the banks. If you look at the S&P 500 overall for the past quarter, the 4 of the 5 biggest losers in the S&P 500 were banks. As you can probably guess, right down at the bottom is First Republic, down a whopping 88, 89% this quarter. Still a lot of questions over this bank despite that $30 billion rescue package that came from some of the bigger banks. But what's interesting is that it's not just this quarter that regional banks have really come under pressure. If you look at the relative performance of KRE, that's the regional banks ETF versus XLF, which tracks the sector overall, you can see that for 2 straight quarters, regional banks have been underperforming to the tune of double digits. And this quarter, down about 19% relative to those bigger banks. That is the worst relative quarter of performance since 2009. Not a size and scope that you love to hear. So even though the worst case scenario right now seems to be avoided, or at least fears about it have gone away, Barclays was warning yesterday about a second wave of deposit outflows coming. As you can see, deposits have been growing steadily since the pandemic. We're going to get an update, of course, from the Fed this evening at around 4:15 p.m.
Katie Greifeld, thank you so much. That is the kind of data points that people are looking for at this moment. Joining us now is someone who has been spot on for a while with being a little cautious and leaning into duration. Now, perhaps more so than ever before, JP Morgan's Bob Michael joining us here on set. I want to start there. We talked just a couple weeks ago, it feels like a lifetime ago, about leaning into duration, about even more so stress in the banking system. Confirms your view. The markets come toward you. Are you doubling down? Do you feel it even more so, or are you starting to question it?
No, I'm not questioning it at all. We're actually looking for an opportunity to add more duration to our portfolios. We're looking at the front end of the curve, 2- and 5-year treasuries. We're expecting a 50% backup from the rally that occurred in March. It puts the 2-year somewhere around 430, the 5-year somewhere around 380. We'd be a buyer there. We think recession is inevitable by the end of the year.
What's the nature of that recession? And I ask this because it seems like, if not a soft landing, that it's not that deep of a recession that we can get through, at least by virtue of where risk assets are priced.
Well, it's the central banks and the aggressive amount of tightening they've done. And it's not just the rate hikes, it's also quantitative tightening. There is a reverse multiplier for that, and that's sucking credit out of the system. I think actually we're transitioning in central bank speak from long and variable to cumulative and lag. The long and variable hit the regional banking system. I think over the next couple quarters, we'll see the cumulative and lag pound away at the economy.
You talk about how you expect really an opportunity within the 2-year yield at a time when Fed officials keep saying, we're not going to cut rates, we're going to pause. You take the other side of that.
Yeah, the Fed officials are saying what they have to say. They're hawkish on inflation. They have to be. They were a little slow off the mark, and for the last year, they've been scrambling to catch up to inflation. Everyone's talked about Arthur Burns and not making a mistake of declaring victory too early. They've won. They've already broken the back of inflation, and I think they probably know it. There are the obvious things. You look at oil's come down 40%. You've had a banking crisis. Banking crises aren't usually accelerated or aren't usually associated with an acceleration in inflation. They're disinflationary, if not deflationary. You look at personal consumption expenditures core today, you've had a 0.3. My guess is next month, it's not a 0.4, it's a 0.2 or a 0.3. Then there are other things to look at. We look at the National Federation of Independent Businesses that survey small businesses. Their price plans for the next 3 months are the lowest they've been since the first quarter of 2021. And even Fed officials have shifted themselves. 17 out of 19 at the December meeting thought the risks were to higher inflation. In March, that dropped to 11 out of 19.
So if that's the case, when do you start to think, okay, we may be getting past this, we may start to see the pain come in, and then we can start moving toward the other side where perhaps we end up with risk assets rallying once again and leading into perhaps riskier credit?
Well, I actually think the next quarter we could see risk assets rally. Having been an investor through the financial crisis and looked at that seminal moment when Bear Stearns and JP Morgan combined under regulatory supervision, I might add, the next quarter was great for markets. Equities went up 15 to 20%. High yield credit spreads retraced a quarter. And then the bottom fell out. I think the ECB also raised rates in July 2008. You could have a feel-good period, and then the reality of the cumulative and lag catch up and slow the economy down. I actually think the data we're looking at it's irrelevant. It's not important. The data that's relevant is the data we're going to see in September.
So the saying, you can remain right, or you can't remain solvent as long as perhaps you may be right, that there is some sense that even if you have the correct idea later on, you have to get the now right. So do you lean into a risk rally that you know will be fleeting?
Absolutely not. I think if we've been taught anything this past month, you may see it coming, you may not, you don't know exactly where it's going to hit, but once it hits, whatever you own, you own. And you have to hope that you own the stuff that recovers. All the regional banks that their bond prices went down, the survivors went up, and the others are headed to restructuring 60, 40, maybe 30 cents on the dollar or lower.
You believe that the entire yield curve could get to 3% or even lower by this summer. Where will it end up by next year? What's sort of the normal yield curve going to look like?
Well, we do think the Fed will start cutting rates in September. And I know some of the markets pricing for that, but it doesn't look like the coupon curve is actually pricing for that yet. I think the Fed will get down to, I don't know, 2.5% to 3%. Maybe the 2-year gets down to about those levels. And the 10-year, depending how long the Fed stays at those low levels, could start going up for 3%. I think that's then. I think for now, I just want to use the next quarter to continue to comb through our portfolios and try to make sure that the known knowns, that we have them in our portfolios, that we have the best quality borrowers, that where we know there are problems in commercial real estate, we comb through our commercial mortgage-backed securitizations, that where we know there's a problem with middle market corporate loans, where they're rolling them over at 2 to 3 times the rate they were putting them on a year and a half ago, that we have the survivors there. And let the others, I don't want to own those.
Spring cleaning with Bob Michael. That's sort of what I call it. This feels like a spring cleaning exercise. Bob Michael, you are staying with us. Coming up, a historic day for America.
We haven't unsealed the documents, so we don't know for sure what the allegations are. If they're what we think they are, my take would be this is a fairly weak case. This is just the appetizer, the hors d'oeuvre. Bigger stuff is yet to come.
That conversation still ahead with Terry Haynes of Pangea Policy.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city, it's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We haven't unsealed the documents, so we don't know for sure what the allegations are. If they're what we think they are, my take would be this is a fairly weak case. A novel legal theory relying on a convicted felon. The next three are huge. The Georgia vote, the taking of secret documents, and of course January 6th. This is just the appetizer, the hors d'oeuvre. Bigger stuff is yet to come.
A Manhattan grand jury indicting Donald Trump, the former president, expected to be arraigned as early as Tuesday as he continues to deny any wrongdoing. Bloomberg's Simone Foxman joining us now from outside the Manhattan District Attorney's Office. Simone.
Yeah, that arraignment would take place here behind me, as would a potential mugshot, fingerprints of Donald Trump. That is what we know at this point. What we don't know is what these exact charges are, because they remain under seal and will remain under seal until that arraignment actually takes place. We believe they have to do with hush money payments made to Stormy Daniels back before Trump was elected in 2016 by Michael Cohen. But the falsification of business records, which is the theory behind this, is not a felony in and of itself. It's just a misdemeanor. So this would have to be perhaps tied into other potential crimes, and we'll see how that plays out, potentially as soon as Tuesday, Lisa.
Simone, thank you so much. Pangaea's Policy's Terry Haynes joining us now. Terry, I'd love to get your thoughts on what just has transpired and what the implications are for Washington and the policy road ahead.
Good morning, Lisa. Three things. One, I think this is sad for the country because the country deserves better than the kind of endless bread and circuses that we've had with the Trump show and people trying to take him down all these many years. I think it's sad for the legal profession because this gets looked at by the country at large as politicized justice with a weak case. I mean, you've got polls showing that 60% see this as politically motivated, and 67% think Trump's payment was a personal expense. You know, and I'd add to that, you know, the idea of a developer in a large city fudging his or her books. I mean, you know, that's pearl clutching time. I'm shocked to find out that happens. And, you know, finally, I'm going to be a little non-consensus on the politics. You know, you've heard the consensus, but I think what ends up happening here is, first, this causes more Trump fatigue in the country generally, and that helps DeSantis because that's part of DeSantis's pitch, is that, you know, we need to move on past this, which most of the party does. Secondly, this may well appeal to the Democratic base, but I think it largely turns off swing voters because they just think it's more of the same. And thirdly, it actually allows Republicans to keep pounding on alleged Democratic sins, including Biden's own treatment of classified documents. So, you know, I think this is not quite what the consensus has it to be.
Terry, do you think that this increases the odds that the U.S. does default on its debt, or at least bumps up and then crosses over the debt ceiling?
I think that's a very smart question. And, I've thought, as you know, I've been very non-consensus since right after the elections last year that there's about a 40% possibility of default. I think they end up pulling back from it. But, some of your other guests said this morning, and I've been talking about this for months, there is going to be a lot of brinksmanship and there's going to be a lot of volatility in the market as a result of it. I think what it ends up doing, frankly, is focusing Republicans in particular on the idea that what they need to be doing here is walking and chewing gum at the same time. They've all run, on local and state platforms, and those local and state platforms include different sorts of accomplishments. Just this week, for example, they've been doing this energy bill that some people characterize as a slap in the face to the administration. And what they need to be doing is a lot more of that. And I think they're going to focus on business as usual and trying to roll some stuff out instead of getting all caught up in the Trump show.
Terry Haynes, thank you so much for being with us. Still with us is Bob Michael. And Bob, I want to move forward on the idea of not just debt ceiling debate, but also we're still dealing with questions around what actually transpired with respect to banking stresses and how much deeper it goes. What would you hope to see the government do at this point to kind of shore up your confidence that this doesn't bleed into something bigger?
Yeah, I think, first of all, the regional and community banking system is vital to the U.S. It extends credit into middle America, and we need that. And I get a lot of questions from our clients about it. I think what we're seeing is the stresses are still there. I look at the Fed data. I actually saw borrowing at the bank term funding program go up by $10 billion. Money market assets went up by $66 billion. That money's coming from somewhere, and it reflects still a lack of confidence in the regional banking system. This reminds me of the S&Ls back in the late 80s, early 90s, when there were a lot of them. They ran into similar problems. Ultimately, the government had to create the Resolution Trust and Resolution Trust Funding Corp, which created securitized debt for investors to invest in. And that created a consolidation of the S&Ls at the time, and I think a relatively healthy banking system. I think we're actually going to need something similar to that now. I think we've got to go through a period where we reorganize the regional and community banks, put them on their own stable footing, and restore confidence again.
As an investor, as part of the shadow banking system that everybody talks about, as we don't understand it, but it's there, you're there, you're going to represent it. How do you play at a time when perhaps some of these banks are pulling back? Do you step in? Do you say, you know what, some of these banks are beaten up? Do you play which ones you see as an advantage, an opportunity?
Well, there are those that have very good footprints. I think they're called now popularly the super regionals. Those make sense to us. Maybe that's the blueprint going forward. And then there are a lot of others that we're just concerned about. And we wonder, how does confidence get restored to them? I don't think the government can permanently backstop them through the FDIC. There's got to be some sort of reorganization coming up.
What about the creditworthiness of the companies that you lend to, both public and non-public? Do you feel that perhaps there is a risk that they do become more vulnerable to defaults, to other distress, as banks pull back?
Everyone's pulling back. The central banks are tightening credit. Now the banks have to tighten credit, and non-bank lenders ourselves. I did 5 client calls yesterday, and all of them were about, what do we own in our portfolios? And as you know, we've been as conservative as we could be, and they're drilling into specific line items and wanting to know. If they're doing it with us, they must be doing it with everyone, and that's going to cause private and public investors to pull back too.
So where do you have to see, because you said that you think that there could be a rally in risk assets, so you're talking in particular about credit, but also equities in the next quarter before the declines come into place. What kind of yields make sense to you on average for, say, high yield, given the default risks that must be implied by a lack of credit?
Well, I think if I can get a running start into this, we had years of excess free liquidity in the system, and it bubbled up in a lot of places. It didn't belong, and that's what's being sucked out of the system through quantitative tightening, and we're naive to assume there's not going to be pain. when the pain hits, when we get into recession, we're expecting high yield credit spreads to go to a minimum of 800 over. I know they're about 500, but I actually can't find a recession where they didn't go to a minimum of 500 over. Where they're priced now was the one soft landing, and that was 1995.
What kind of default cycle are you looking for with respect to that type of yield scenario?
Well, defaults could get up to around 6%. I don't know that the public high yield market will go much above that. 94% of it will be money good. Even the worst of high yield cycles, when defaults got up to 10%, 90% of it was money good. It didn't stop the rest of the market for repricing. There will be risk aversion, there will be flight to quality, there will be de-risking, there will be holders of lots of other problems, whether it's in private capital, in their equity portfolios, or even in the public bond markets. It creates de-risking.
Just real quick, which is more attractive, private or public credit right now?
Public credit.
Bob Michael, thank you so much for being with us. Really appreciate it. Bob Michael there of JP Morgan. Coming up, the market moving events that you need to be watching. That's next in our Trading Diary.
We can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday. This is Bloomberg Markets, The Open, here with a look at markets closing out a quarter of gains, of pretty substantial gains in certain sectors. You can see up about 0.5% as the S&P and the NASDAQ up about the same. The Russell outperforming yet again with a 1% gain. If you take a look at bonds, not really doing much. Yield slightly lower as people calibrate after a pretty whipsawed couple of months. But I want to take a look at quarterly results. We have seen the NASDAQ deliver the best quarterly return going back to 2020 with almost 20% gain. The S&P up by 6%, and you can see the KBW Bank Index down almost 20% for the worst quarter going back to 2020. Time now for the Trading Diary, what you need to be watching this week. The UBISH Sentiment Survey coming at the top of the hour. ECB President Christine Lagarde speaking at 11 Eastern, followed by Fed Speak from Williams, Waller, and Cook. Looking ahead to next week, ISM manufacturing numbers on Monday. Cleveland Fed President Loretta Mester speaking on Tuesday. Jim Bullard on Thursday. Finally, the main event, the U.S. payrolls report falling on Good Friday. We will be here to break it all down. This was Countdown to the Open. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight, with replays all weekend on Bloomberg Television and Radio. Bloomberg has the Fed coverage you're looking for. Monday, an exclusive interview with St. Louis Fed President Jim Bullard.
The benefits of getting inflation under control quickly are vast.
For all your Fed coverage, keep it tuned to Bloomberg.
This is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is, when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just attacked that video and were like, you explain things so much better than my boyfriend or my professor, or I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that They're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.8 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste. For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I'm currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor. Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. Very good. 9th class. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation. A language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings, as well as you're going to describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, She came to the Gaulidoddi campus and then she toiled very hard for 1 year despite many problems. And today I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students so that whoever is interested in whatever activity they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 meters of sky gardens, reflecting pools, waterfalls, planter terraces, and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. You have to make sure that no combustion engines will be in the city in the middle and the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right? As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel?
1, you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges, or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while, and I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Via and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G, and it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice: nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology, and live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。
不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高。但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the year through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of like losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. The queen of live streaming, Via, she is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. The king will be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce, and he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
里面有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to show in some ways that they're authentic, right? So for Via and Li Jiaqi, they are able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products because to him that's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是你一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things because you see it live. Something because social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. and they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top-tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows. And we see like P&G have their own sales room, which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming has definitely transformed the way product owners can think about how to reach their consumers. And it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。
接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaxi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusaari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate, and that rotation extends deep down below the surface, and the waves can be very long. They can be several hundred meters long. And as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters of Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming in to our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Ina Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1996, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Ina wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
Solar and wind energy were fully commercialized. There were a lot of amazing technologies implemented everywhere. I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Inna co-founded EcoWave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring, or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station.
This is the EcoWave Power conversion unit that has been operating in Jaffa Port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100-kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Inna and her team are working on another 100-kilowatt project at the port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the success of wave energy companies today as opposed to like 20 years ago. But in the next few years, or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely, wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy friendly world, we need all renewable energy sources to work together.
people from? Who are all these people from?
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He is making you, but you act for Nissan. I mean, it's corrupt. The system is...
One of the most dramatic elements was Ravinder Pasi's home being raided by court officials in Yokohama.
You scared me. You scared my children. I worked in Nissan for 16 years.
So Rav Pasi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn. And he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Pasi. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, you know, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way, it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Passi was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
It's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Harinada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian.
Hello, Mr. Hadi.
And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Harinada was somebody who actually recruited me into the company, so I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Harinada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Harinada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Passi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because me, members of my team, were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon, I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered for me the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board, and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Goan Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who'd spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? This is a car company. This is not the KGB.
I think it's fair to say that Rav Pasi didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Hari Nada is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think, he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you've got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera
It's a
to
very
me.
sad thing.
It's a family feud.
A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against JP Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going. And I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with JP Morgan letterhead, and just started sitting at the kitchen table, just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to JP Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating them. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. Seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself. But at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s. When everyone had a nickname, his was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3. Amongst that, was very successful and made very large amounts of money as a young man. But inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Baden-Boyce is a very wealthy place. You have to have a considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but it's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. And the law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had is kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2, 3.
If you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work, Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system. And you end up in sort of a race to the bottom. And that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
the Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes! It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is, is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial, be like a sports car. Yes. We got up to about 108 miles an hour on that test. And it's a short run, it's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was like, is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single supercity economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. But in a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure that different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe.
On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be part of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's done super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $7 to $9 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel is now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, we've kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial. It'll never be supplied in the quantities we need it. You know, blah, blah, blah. Now we know, let's take action. It's practical. It's implementable. Let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, you know, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution.